A very good morning to all. So today we have a session on intricacies in GST audit, and the main objective of this session was once the extension of GST audit was extended to 31st October. It was 31st October and shifted to 31st December. So we all have now slowed down and we have shifted our focus from GST audit to something other. And then also we had Diwali and staff ka problem to hai. So, with this intention, we have kept this session, and we have with us CA Ravi Somani. About the speaker, he is a qualified chartered accountant and is pursuing LLB. He practices exclusively in the area of GST, customs, and foreign trade policy. He has performed indirect tax reviews across various sectors and provides support on advisory and litigation matters in GST. He has given lectures at various trade and professional forums on service tax and GST. He has authored two books on indirect taxes. The first one is Practical Guide to GST Audit and Certification, published by Bloomsbury recently. The fourth edition of this book was released. And the second book is Self-Study Guide to Indirect Taxes, published by Asia Law House. He is a regular contributor and shares knowledge by writing analytical and issue-based articles, research papers, and judicial updates on indirect tax matters. He likes solving critical indirect tax problems and providing pragmatic, workable solutions. Sir, on behalf of Pune Camp CPE Study Circle, I welcome you and request you to begin with the session.
Thank you very much, sir, for the invitation and also for this introduction. Firstly, I would like to thank you for coordinating in this entire session, making sure that the session happens and it happens in a proper manner. And I also would like to thank the entire committee of Pune Camp Study Circle. It's one of the vibrant groups doing tremendous work in the various fields as far as the training, seminars, and educating the members is concerned. So before I begin, firstly, I would like to check whether my voice is properly audible, or you want me to make some adjustments. Chaitanya ji, you need to support me on this.
Yes, I think it is audible right now, and it's perfectly fine.
So in case any technical issues, please you can just call me or let me know so that I can immediately correct it.
I'll interrupt and I'll tell you.
Perfect. Thanks a lot. So today's topic, GST audit. I'm sure each one of you might have already gone through this session at least more than once, or at least once earlier, because it has almost been 2 years since the time we are learning, understanding, and trying to know the intricacies in GST audit, wherein we have also completed one entire round of filing for financial year 17-18. So each one of us also have got the proper hands-on experience in performing the GST audit. Of course, you all must be knowing that currently the timeline for filing this GST audit is 31st December 2020, and the time has just passed. I would say, from the time the extension came, we never thought it will be 3 months, but it came as a 3 months extension. And just as a matter of time, now it's just remaining 40 days out of this 3 months. So effectively, as professionals, we would have to complete our Companies Act statutory audits, if any pending, income tax. One of the deadline falls at the same time. Then there is GST audit, and of course, which Chaitanya just mentioned in the start. There were a lot of challenges. This particular year had been quite challenging, but it has also taught us a lot. From a practice front, yes, members must have had a problem with article students not being in office, or being on examination leave for an extended period of time due to delay in the examinations and all these things. But nevertheless, I think we have learned a lot. We have learned different ways of doing things, and it all is a part of learning, I would say. So firstly, again, I would like to, I hope that each one of you are taking adequate precautions. At least the news that is now coming is quite encouraging, quite positive, that we may have a cure or a vaccine available with us another 3-4 months time max. So which is a good news. But till then, we have to continue to stay safe. And I hope you all are taking precautions and just a bit more of time, and we should be seeing ourselves. And I would love to come over there and give a session on various topics and meet all of you. So with this brief talk, I would like to straight away go into the topic, because today's topic is very important, very relevant. As I've already mentioned in the start, that we have already gone through one round of filing. So today's discussion, I would like to keep it or restrict it, or uh, 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 take more time towards intricacies, because that is what the topic is. So the idea is to discuss, to deliberate upon the various issues and the challenges that are being faced by us in the course of filing GST annual returns and 9C certification, and what could be the possible solutions to those problems. And we would not be focusing on field by field understanding of the form, because that is something I understand that is already aware. You are already aware of those things, but still, for the benefit of those who are not aware, we would look at critical aspects in the forms as well. So with this, we will start our session. And in case anybody have any doubts, you can simply raise a hand. In case you feel that the question needs to be asked then and there, you can raise a hand. And Chaitanya ji, you can just help me with that query, in case any query coming in the middle, and that particular query has to be solved then and there. And
Yes.
of course, we will certainly have last 15 to 20 minutes for Q&A to take up all the queries and other things. So with this background, we will start our topic. GST audit for 18-19 now. It is quite unfortunate that even while we are sitting in November 2020, we are talking about financial year 18-19. So I think by now we must have been already working on financial year 19-20 and come on track even for financial year 2021, because any client would require a live support, live. So it is like we going to the client and telling today that, oh no, this is wrong, this is incorrect, and you need to pay taxes, which is still fine. But asking them to pay interest and penalties is where the real pinch comes. And that is where we need to discipline our clients. We need to discipline ourselves, our team, to make sure that we immediately complete this 18-19 and immediately take up 19-20 and be on track. By 1st of April 2021, we should be on track up to 19-20 closure of GST audits. So now, let us just go back and look at the recap of what were the possible compliance issues and overall compliance view as far as financial year 17-18 is concerned. So, the 9 and 9C were filed in a customized manner. The reason I say customized manner is because of the fact that for few associates, in the middle of the period, the forms got changed. They have done major changes. So there were few associates who filed the older version, few associates have filed the revised version. Earlier, there was true and correct certification. Later, it got amended to true and fair. But by the time they amended it, I think almost 40% of compliance was already through. So it was more of a customized version of filing which was being done. In fact, for 18-19 also, there are some relaxations which the government has given, which they are still not continued for 19-20. Now, if they doesn't continue that, then again, it is going back to, the complicated forms. And there are a hell lot of complications if they do not relax those, restrictions. Coming to accounts records, what has been largely seen is that businesses have done fairly good as far as maintaining the documentation, accounts records. What has been seen is that on the outward supply front, on the sales front, the transactions, the invoices, documents, agreements, records were quite strong. But on the purchases front, on the ITC front and the reverse charge front, the compliance was quite weak. And there were a lot of issues. Businesses were not aware about the taxability of reverse charge on various transactions. One of the critical was ocean freight. Ocean freight was, something, even the large enterprises, I can tell you large MNCs have also just missed out on that. Of course, the question always remains that whether it is taxable or not. Legality is always there, which certainly we will discuss in the course of this discussion. GST two-way reconciliation was again, one of the big headaches which was there in financial year 17-18 GST audit, which is also there in 18-19. Unless the government really solves this problem, the time may come that professionals may start thinking, or businesses may start thinking that this is of least importance, and let's not give any importance this document called GSTR 2A. But yes, as it is having an orchestrated value which has been there to it. So, there were some compliances. I can also say that there were 9 and 9Cs which were filed with, information given to the extent possible as far as two-way reconciliation is concerned. And we did not got into, rupee to rupee level of accuracy and matching, which is absolutely difficult. Then reverse charge, as I've already told, there was quite a bit of non-compliance over there. Wherever there has been issues in terms of taxability, we have recommended, and that is where the taxpayers have made the payment by disclosing the details in Part 5. That is where the auditor would recommend the tax liability. There were diversified opinions as to what is the role of chartered accountant in this GST audit. In fact, I can say that even today that particular question is not resolved. I would certainly like to give my views on this topic as to what is really the role of professionals. Where is that? What is that we need to cover, and where is that we need to stop and say, okay, this is beyond the purview of an auditor. So this is something interesting, and we will discuss, in the end of our today's session. Documentation of the work done is another very important thing. This is the documentation I'm talking from a chartered accountant's perspective, because see, we need to understand that this GST audit holds a lot of importance for a simple reason that whatever work that we are doing today is also going to be further audited by the department. And you must be knowing that department has already started their audit. They are just, waiting for this vaccine to come, and, they are just waiting in queue for, starting their physical audit. And across, the letters are being issued for asking for various information for GST audit. Now, what is going to happen is that when department comes for the audit, the first impression is the best impression. And if you have all the data, the sequence, the information, the way in which it has been properly kept in a proper manner, you will just go in one meeting and you would impress upon the officer and say that, the assessee is absolutely compliant. Since you have done the GST audit for that assessee, and whatever was payable, you've already made them pay. But let's say despite we doing GST audit and we are struggling with our documentation and working papers, it certainly gives a bad impression before the client, before the officer, and we may also lose a precious client of ours. Most importantly, it's not a good practice that must be there. So as a professionals, documentation and working papers is of utmost importance. We need to take out a week's time after completion of the entire exercise, or ideally it has to be real time. But if it is not real time, then a week's time after completion of this entire exercise for documentation, so that whenever any person asks for any information or audit, that information should be available in a good manner and a proper manner with us. This is a broad recap of 17-18. As far as 18-19, you all must be aware that there has been some tweaking in the turnover limits. Earlier, annual return was applicable to everybody, and 9C was having an aggregate turnover limit of 2 crores. So now the annual return is having a turnover of 2 crores, and 9C it is 5 crores. So let me tell you one very, very important thing is that when we say turnover, it is aggregate turnover. So when we say aggregate turnover, it means the turnover on an all India basis. Obviously, let's say a company having 5 registrations, and just because Maharashtra turnover is less than 2 crores or less than 5 crores, I cannot say that it is not liable for GST audit. But as long as aggregate turnover on an all India basis is exceeding 5 crores, it would be liable for GST audit, all the registrations. Most importantly, at times what I have seen is that professionals are evaluating the aggregate turnover, looking at the turnover in the financial statements. Let me tell you, although largely it is a correct way, but it may not lead to a correct result always. Reason being that the aggregate turnover in GST law is quite wider and much covers a much larger aspects than the turnover as reflected in the trial balance or in the financial statements. So we may actually fall on a wrong footing as well. The reason being, let's say there is a stock transfer. Stock transfer would come in aggregate turnover, but it may not come in turnover. Let us say exempt supply. Exempt supply also comes in the aggregate turnover. It may also be a part of aggregate turnover, let's say interest income, but in the indirect incomes. So the point which I'm trying to say is that the deemed supplies, the supplies where the valuation has been made an open market value, or the supplies which are in the nature of Schedule 1 transactions, related party transactions, uh, interbranch transactions, all those also needs to be considered to evaluate this 5 crore limit. And most importantly, you need to look at the 5 crore for that financial year, and you need not go for the previous financial year. Unlike e-invoicing, in case of e-invoicing, they have told that in any of the previous financial year. In 9C exercise, it is not like any of the previous financial, it is for that financial year. So this is very important thing. Of course, we need to understand that certain transactions are out, like dividends, sale of land, securities. These are all out because they are neither a supply of goods nor a supply of services. So they need not be considered for the purpose of computation and calculation. So now let us jump into the intricacies or issues in the course of that we would face in the course of filing of these annual returns and audit. Now, one important aspect that we need to understand is that this entire exercise can be divided in two parts, either GSTR 9 and 9C, or we can break it into outward supplies, ITC, and reverse charge. I would prefer to discuss in this sequence rather than first discussing GSTR 9 and then discussing 9C, because as I've told, the focus is not on forms, the focus is on the issues. So the sequence of today's discussion would be, first I would take up the issues on outward supplies, then I would take up the issues on ITC, and then I would take up the issues on inward reverse charge transaction, and then other procedural issues, and part B, certification and the reporting aspects. So this is how we will go forward as far as the sequence is concerned. Now, one of the fundamental issues that comes as far as the outward supplies is concerned is, what is this annual return? I mean, is it a self-assessment, or is it something auditor's assessment, or is it something provisional assessment? What is it exactly? And why this question becomes very important is because when you look at the third para in the slide, where it says that the credit referred to in subsection 1, that is 41 subsection 1, shall be utilized only for payment of self-assessed output tax as per the return referred to in subsection, that subsection. Now the point is, if it is a self-assessment, then while making the payment of taxes, you can also utilize input tax credit. But if it is not a self-assessment, then you cannot utilize input tax credit while making the payment of taxes in the course of filing GST 9 and 9C. Now let us look at, what do you call self-assessment? When do you call something as a self-assessment? Now, Section 59 of the GST Act, CGST Act, which basically is a relevant section as far as the self-assessment is concerned. It says, every registered person shall self-assess the taxes payable under this Act and furnish a return for each tax period as specified under Section 39. Now here it says that return under Section 39. Now mind you, return under Section 39 is GSTR 3 or GSTR 3B with the latest amendment that has happened. But the 9 annual return which has been filed is a return under Section 44. It is not a return under Section 39. Now, a very important question that comes is that when we strictly read an interpretation or a strict wordings of the Act, that is Section 59, this annual return does not seem to be a self-assessment. So if it is not a self-assessment, then what are we trying to really achieve, or what are we trying to do? At one stage, we are telling to our clients that this is the last opportunity. You please, whatever extra liability that come across, you please add it and make sure that everything is properly incorporated and all that, 100 things. and on the other hand, it is not a self-assessment, then actually what it is. So department, as always, they never clarified as to what it is, because they feel as long as it is not clarified, they can take it to the courts and dispute the matter. This is very unfortunate way of dealing in tax laws. But I'll tell you the history and the background why this problem has come. So basically, department never wanted this to be a self-assessment. As far as the strict reading of, which is also coming out in section 59, they never wanted it to be a self-assessment. Because if you see the very first version of the form annual return that came, it was supposed to be just an auto-populated figure of GSTR 1 and GSTR 3B. That's all. It was never supposed to be you adding anything to it. It was just supposed to be a summary of all your monthly returns that you were filed. Now, once that form was released, there was a lot of hue and cry, and businesses, professionals started saying that what is the fun in giving this form when you say that it is just a summary? You can might as well extrapolate it from your system. And why do you want this entire exercise to be done all the way? So then they realized that saying that GSTR 9 is merely a summary they may fall on a wrong footing. And then they immediately changed and stated, no, now you can do the changes in GSTR 3B. Then immediately a question came, okay, if I can do the changes, which one should I look at? Should I look at GSTR 1 or GSTR 3B or books? So that was another question that has come, which also, they have clarified not fully. So finally, in one of the press release, they have indirectly indicated. Now look at the language which government uses. And the most funniest part is that it comes by a press release. Now we don't know what is the authenticity of these press releases. There is a law on circular. There are judgments on the authenticity of the circulars that are issued. Time will tell. There will be another Supreme Court judgment to say what is really this press release and what is the binding effect of these press releases on the assessees. So again, that will go to the Supreme Court. And the most funniest part is that at the whims, the press releases get deleted from the website, which is absolutely unfortunate. That first of all, the press releases don't have numbering. Now this is the most funniest part. Now I don't know whether it is intentional or unintentional, not giving a proper numbering to the press release. And the most, as I've already told, even if SSC relies on them, it gets deleted from the CBIC website. Anyway, so in a press release in the month of July 4th or July 3rd, which has come, it has stated that GSTR 9 indirectly, this statement has not come directly, but indirectly, what has been stated is that this entire exercise you are doing under section 73, subsection 5, and not under section 59. Now, why this is important? Because they are saying that this is an exercise that before issuance of a show cause notice, if an assessee wants to pay the tax on the basis of his own ascertainment, that is where you are doing this exercise and you are filing under 73.5. First of all, 73.5 is actually totally for a different context. It is an adjudication mechanism. And GSTR 9, there is no adjudication which is happening. It's actually an self-assessment. You strictly read, section 59. It may be otherwise, but you understand the objective and purpose. It is a self-assessment, and it's absolutely vague for me to take it that it is under 73.5. So my submission here would be that although literally reading section 59 says that self-assessment does not cover GSTR 9, but that is what when the original form in its original or the pure form would have been implemented. You have done all the tweaking with the forms, but you did not change the provisions in the act. So a literal interpretation, if it leads to absurd results, in my view, that interpretation must not be adopted, and a more objective-oriented interpretation must be adopted, and GSTR 9 has to be a self-assessment. Now, once we conclude that GSTR 9 is a self-assessment, it opens up very important question, is that the form says that while paying taxes through GSTR 9, you cannot utilize input tax credit. Now, I am totally against this entire version. How can you say that you cannot utilize input tax credit while making a payment or remitting a payment while filing annual return? When it is a self-assessment, when the entire mechanism you are telling that you add, it is a last opportunity for you to disclose and declare and correct your mistakes, errors, and all those things. On the second part, you are saying that you cannot utilize your input tax credit with no rectification mechanism given for your monthly returns, and that too capping a time limit for rectifying details, and no mechanism or system of revising your monthly returns. I mean, you are just expecting assessees to be gods, professionals to be god sent, something where there would not be any problem, and that were the initial years of filing of implementation of GST. Why such unnecessary restrictions is a question. But my submission is that the whatsoever the instruction says in the form, the instruction is not the law, and the instruction cannot go beyond the law. So the objective purpose of the law holds importance, and one has to give a liberal interpretation over there. And if there is an assessee who is having a huge amount of credit lying in accumulated in their electronic credit ledger, in my view, a strong and an aggressive view can be taken of utilizing the input tax credit while making remittances for filing annual returns. Certainly, I would like to inform that department can dispute this aspect. Department may issue a show cause notice, but eventually, in my view, the courts will held this particular thing in favor of assessees, because that is what largely, when we look at the various high court judgments, I can easily say that it is 80-20 or 85-15, where 85% of the judgments are coming in the favor of assessee. Now, one important thing which I would also like to mention here is that let's say there is any issue or something that comes in the course of filing of various monthly returns or various things. One may say that, sir, why do I get into dispute of putting things in annual return? Can I put it in the monthly 3B return of, let's say, this month, November 2020? It's already gone, sir. Yeah, November 2020, which will be filed in December 2020. The example which I'm trying to explain is that, let us say there is an assessee who is having a liability of 10 lakhs coming as a part of GST audit exercise for financial year 18-19. Now that assessee is having a huge amount of input tax credit lying in their electronic credit ledger, and you are in a fix where you need to see that if I ask them to utilize input tax credit, it goes against the instruction, which is surely going to be disputed by the department. And on the other hand, if I make the assessee pay through cash, it would be unjust, wherein there may be a positive judgment coming on, which the benefit assessee is not able to take today. So it is a catch-22 situation, which is actually created. Now, here, one of the important point which I would like to explain is that one can take a view, if you want to take a bit of aggressive stand. I would not say it is not. It is also not an aggressive stand. Is that why don't you correct that mistake in the return to be filed in the November 2020? That is, sir, how can we put the details of 18-19 in November 2020? Why not? Why not? No, sir, there is a particular ROD which says that the rectification can be at the max done by the next financial year 2018, September 2018. For 18-19 cannot be done after September 2019. Let me tell you, it's all nonsense, and it's only the time that all these things will be quashed. And these all unnecessary procedures cannot take away the rights of an assessee. And this is something not what I am saying, and this is something exactly what courts have already held. This is something exactly circular issued by the CBIC has already stated. Now that's why I've quoted this paragraph in the circular. See, initially they wanted GSTR 1, GSTR 2, GSTR 3. They just fell flat onto it. And of course, now all the new news is coming, which I'll also talk about a bit. Now, various amendments, corrections, and rectification. There was a circular number 26 issued in December 2017. Now, over there, it has been stated that various representations have been received wherein registered persons have requested for clarification on the procedure for rectifications of error made while filing their Form GSTR 3B. Now, initially, they issued one more circular in September 2017, dated circular number 7, where they told that you cannot rectify anything in GSTR 1 and 2. All the rectifications must be done only in the The next GSTR, sorry, all the rectifications must only be done in the GSTR 3 as and when it comes. But then that circular was never operationalized. And after the relevant notification was done, that circular was totally kept in abeyance. And till now, I think today the entire thing has, taken a death. So now circular number 26, this is exactly what circular number 26 says. If there is any liability underreported, liability may be added in the return of subsequent months after payment of interest. Now here, it doesn't say that it must be restricted to September of the previous next financial year and all that thing. If there is liability overreported, you either claim refund or adjustment where feasible. Now, let me tell you, adjustment where feasible, very important for us to understand adjustment where feasible. I will talk about it a bit later, but for the time being, you can just note that circular 26 says that if there is any liability which is over-reported, you can either claim refund or adjust where feasible. Adjust where not feasible to go for refund. So sorry, where not feasible, you can go for refund or you can also adjust. So that is exactly what the circular says. And where it is wrongly reported, you can correct it in the subsequent month. Now, this particular circular, let me tell you, even today it is in existence. It has not been suspended. It has not been rescinded. It is still active and it is still applicable to all of us. Now, there are Supreme Court judgments which say that a beneficial circular the benefit of the beneficial circular can be taken by the assessees. Now, this is a circular which has been issued, which clearly says that any rectification can be done in the subsequent financial year, which is still active. So, why an assessee cannot take the benefit of this circular and go ahead and put the details in the subsequent returns of November 2020 and make the payment of taxes by utilizing input tax credit? Now, this particular thing was also went into court in the case of Bharti Airtel. I think this was the Delhi High Court, wherein these are the comments or the remarks of the court. Quite interesting. That's why I've just put this up on the slide. The CGST Act contemplated a self-policing system, under which the authenticity of the information submitted in the returns by registered person is not only auto-populated, but it is verified by the supplier and confirmed by the recipient in the same month. This is what they told it will be. But since the respondents, that is the government, could not operationalize the statutory forms envisaged under the Act, resulting in depriving the petitioner to accurately reconcile its input tax credit, the respondent today cannot deprive the petitioner of the benefits that would have accrued in favor of the petitioner if such forms would have been enforced. So the nutshell of this judgment is that you can do the rectification. You cannot deprive an assessee an opportunity of rectifying just under the guise of calling that time limits. And these are all unnecessary artificial time limits and restrictions. Let me tell you, they will fall flat in the courts. Now, this is exactly my submission as far as rectification of details can be very important in all the assessees where additional liabilities are coming. Now, coming to what should be the source of information for filing this GSTR 9 and 9Cs. Now, as far as the source of information is concerned, some may say there was a lot of dispute in the start whether we should use GSTR 1 or 3B or books of accounts. Somebody, I think largely people today may agree that it has to be as per books of accounts, but I would actually partially agree to that view for a simple reason. Let us say in a particular month, or in a particular transaction, even the books of accounts does not reflect details, or if the books of accounts reflect the wrong details, then do we tell the taxpayer or the assessee to put the wrong details just because the books of accounts we need to go as per books of accounts? Answer is no. For example, let us say that assessee has missed disclosing the details of reverse charge, or missed recording the liability of reverse charge in the books of accounts, but still we make them pay the tax liability under reverse charge if it is identified in the course of audit. Or let us say that assessee has wrongly recorded CGST, SGST as IGST in the while passing an accounting entry, which is also very much possible, and these kind of issues have happened. So then do we say that no, you pay IGST because in the books of accounts you have recorded IGST? Okay, that books of accounts might have been audited, and that issue being immaterial might not have been noticed in the course of statutory audit. But that does not mean that you make the assessee pay the wrong taxes. I would rather say that it is neither GSTR1 nor GSTR3B or nor books of accounts. You need to disclose in annual return what is correct as per the law, without taking bias of any of these forms. Whatever is correct, I mentioned, it is a self-assessment, it is an opportunity to correct mistakes. Whatever you feel is correct, the correct details has to go in the form. Many times, I will tell you that in the course of filing this GST 9 and 9C, there may be so many confusions that may come. It can be as simple as that whether this particular information needs to be reported or this need not be reported, where it must be reported. I would say the guiding force that that can guide us is that we need to simply ask ourselves, what is the correct disclosure? What should be the correct disclosure? And that correct disclosure should be our conclusion in arriving whether we need to disclose or not disclose, or where to disclose any particular thing in the form. Now, so this is about GSTR1. The details that needs to be submitted in respect of outward supplies. As far as the inward supplies is concerned, ITC, they have told that you cannot take any ITC in the annual return, and you have to only disclose the ITC as per GSTR 3B, which is fine. But then there are some interpretational issues over there as well, which I will touch upon when I come to input tax credit part of the discussion. Anything which is tax is extra paid or excess paid, the refund application has to be separately applied. Unlike in the VAT regime, where the annual return file itself, was an application of refund for claiming the refund. In GSTR 9 and 9C, let's say if there is associated paid extra tax and the refund, it should be applied. It has to be separately filed. You cannot claim refund directly through the annual returns. No input tax credit will be availed in annual return. I've already discussed. Adjustment of benefit noted in with the tax payable. So that can also be done, adjustment of any benefit noted with the tax payable. There's something more on the adjustment which I will talk in a bit more detail in coming slides. Now, see, one important point or one important aspect that we need to understand is that this entire exercise, let us not think, or let us not restrict ourselves that we are doing only 9 and 9C reconciliation. That's all. The job of auditor or the role of auditor is only to do the reconciliation, nothing more, nothing beyond. I will tell you that we may not be totally correct in our understanding. Possibly, I would reserve this, the reasoning for this in the end when I would cover into the certification. Now, as an auditor or as a professional guiding the clients in filing annual returns, we need to also look at certain important things. And it may so happen that, and what has been largely seen is that the form itself is so complex, and we are so badly lost in the reconciliation that we really don't pay attention to actual important information or the actual important things. Now, why this is very important is because, again, the same point that our work is also going to be audited by the department. And let me tell you, time is not far. They are already starting the 17, 18 audits. Now, let us say that we have restricted ourselves only to reconciliation. And in the course of audit by department, there are so many issues that are being noted on the technical front, on the interpretational front, on the legal front, which we have not even focused on in the course of GST audit. Then it may go bad to our reputation, our name, our vigilance in doing the work. So some important aspects to be taken care. I'm only focusing on the common issues or common errors. There can be many more things to be covered. There can actually be a separate session only on the issues and various other these topics. Now, let's say taxability. On taxability, deemed supplies, a transaction where there is there's a permanent transfer or a disposal of a business asset, where one has taken input tax credit on an asset. Now, as per Schedule 1, it is a deemed supply even if there is no consideration in this transaction. Now, did we look at various industries? Let us say hotel industry. Certainly, there will be some sort of a damage, some sort of a disposal and let's say pharmaceutical industry, FMCG industries. Now, where to draw the line? There will be in manufacturing industries, there will be removals for testings, trials, samples. There will be removals for various other purposes. And at times, it can also be a permanent removal, permanent disposal. Stock transfers. We are just relying that whatever that stock transfer assessee has paid GST is correct. Are we really getting into the inventory records? How can we restrict our GST audit only to the financial statements? And because the stock transfer, it also does not come in the financial statement. Strictly speaking, in the revenue side, you will not find income from stock transfers. It doesn't come. It gets knocked off at the time of finalization. So, stock transfer, for example, we need to go into the inventory records. What has come in, what has gone out. Let me tell you, in one of our clients, when we asked them question that, are you paying on stock transfer? Yes, we are paying. Okay, we thought, okay, he's paying on stock transfer, no need to do. But then we thought, let us actually look at their inventory record. So what we did is we just asked their inventory register and just took a sample of 1 month. And we've understood for what all reasons the material is going out. So as long as the reason is a sale invoice, is linked to material going out, we were not bothered. But it was other than a sale invoice, we investigated or we probably, gone into the details of those transactions. And we found that there were so many materials which were given to, engineers as samples to be given to their customers. Which was not brought to our notice. In fact, it was brought to our notice, but the quantification which was given by the auditee was not correct. And actually, there was a larger quantification of inventory which was removed as samples. Now, the important question that comes is, these kind of things we will come to know only once we get into the inventory records of the assessee. And this is exactly what department is going to check. Let me tell you, this is exactly what department is going to check. So on a materiality level, certainly an auditor needs to check these aspects, cross-charge. Now, there can be a company having multiple registrations across India. We need to see whether there is any deemed supply, whether there is any common service which is being getting supplied across the locations, IT, HR, administration. There can be many more trainings, overheads, any other sort of overheads which are being there. Not just the same company. Let us say there is a group and there is a common facilities and common amenities being utilized by all the entities, separate entities within the group, which are also in the related party category. Would that cover in the tax net? Very, very important. Recoveries is another, big area. And let me tell you, it is a largely a non-compliance area, where I can tell you that even MNCs for whom we are doing the GST audits, large companies as well are falling flat as far as this recovery is concerned. And let me tell you, each recovery has a different treatment. You cannot adopt a treatment for insurance recovery to the telephone recovery. You cannot adopt a treatment for telephone recovery to a canteen recovery and a canteen recovery to transportation recovery. All are having different tax treatment. And the law has got multiple times changed in that area. So whether the ITC is eligible, whether we need to pay on the output, or whether we need to simply reverse the input tax credit, or if we need to pay at what valuation it requires to be paid, all this requires a detailed understanding. So that is where we need to understand what are the various recoveries in the business and focus and verify that as a part of GST audit exercise. Very, very important. Of course, I would like to mention that there is recently an advance ruling in the case of Tata Motors, where they have mentioned that transportation recovery is not liable for GST. I'm very happy that this ruling has come. And if you ask me, this could possibly an interpretation which the High Court can also take, especially in cases where the recoveries are in the nature of employees, because ultimately it is an integrated part of CTC. So what has been stated in the advance ruling is that eventually or ultimately it is an integrated part. It says integrated part of the CTC. And it should not be liable for tax, and it would fall in Schedule 3, being a transaction between employer and employee. Should be out of GST net. But of course, till the issue gets totally resolved, there are assessors who do not want to take any risk and just pay off the taxes as long as it is not quite material. No point in unnecessarily getting into disputes always. So that is where a decision to be taken on recoveries. Classification. Again, I don't know how many of us are really verifying whether the rate of tax to the relevant HSN code is adopted is correct. And the worst thing which I see is that how do you know whether the rate of tax for the HSN code is correct or wrong? The worst thing is that we Google. I've seen few articles in my office Googling when I say whether the rate of tax for this HSN code, and they just Google, and I had to literally, tell them that this is not the correct way of looking at the tax rate. You need to open the book, you need to open the notification. There has been a multiple times when the tax rate has been amended. What is the authenticity of the website you are checking on Google? No, sir, it is this website. It's such a renowned website, renowned ASP, GSP, and we are seeing in their website. So what? Let me tell you, none of this is authenticated. And this is something we have seen where on Google there is something else, and sometimes we send a message on WhatsApp in a particular group and ask what is the HSN code, what is the rate, as if the other member is an expert, and we cannot rely. In my view, this HSN code verification and the rate verification is an essential part. It is a backbone, and if we are doing wrong over there, let me tell you, just imagine, let's say an assessee who was supposed to pay 28% has paid 18%, or who's supposed to pay 18% has paid 12%, and we have not taken a pain of verifying the tax rate. And let's say if the demand comes, additional 6% on the turnover, additional 10% of the turnover. Just imagine after 3 years, if additional 6% of the turnover, if the government asks that assessee, with that assessee not having a choice of collecting that money from the customer and paying to the government with interest and penalties, can go up to 20-25% of the turnover. That is not even the profit, but that one is making. And one issue from our side can lead to such a big impact. 20-25% is a year's turnover of an organization gets eroded. So very important that we not just check the rate to the code, but we also check the correctness of the HSN code at the time of doing the GST audit. Very, very important. Let me tell you, at least 90% of the GST audits that we have done, we have found that in each and every client, there is some or other issue in the HSN code. This is, I can easily place this in the common issue or a common error being faced by the assessees. Valuation. Again, as far as the valuation is concerned, in certain cases, there is a clear law that it has to be valued on an open market value basis. For example, transactions with related parties. So is it really been valued accordingly? We need to at least do a sample verification of the same. There is a benefit of valuation as well. Let us say in case of a motor vehicle, when you are selling a second-hand vehicle, they say that you just pay on the difference value of the depreciated value and the transaction value, the difference of it. If it is positive, you pay. If it is negative, you ignore. And if it is positive, that too you just pay at 12%, 18%, and the reduced rate. Now, this is such a substantial benefit. And if the client has already made payment of which is extra, you need to go ask them to apply for refund if the time limit is still there, because 2 years is the time limit for claiming refund. So let me tell you, as a part of GST audit, we can surely add a lot of value to the business of the client as well. We should not just look at this particular exercise as a exercise of only finding the faults. If there are some improvements in systems, controls, processes, in the way of doing things, and something which has been benefit which has been available, like say sale of vehicles, where he has paid on 28% plus cess, which was not required to be paid. Discount incentives. There is such a big issue on what is the meaning of the term incentives, or what is the meaning of the term discounts. Automobile dealer industry, any dealer distribution industry in the food sector, FMCG sector, pharmaceutical sector, such a big issue. Manufacturer distributing sectors, where the manufacturer pass on the various incentives. Now, how do you draw a line between what is discount and what is incentives? Now, we need to understand that there is a difference between consideration for supply and condition for supply. Now, just because it has been named as an incentive, just because it is required to promote a particular product, it doesn't become a sales promotion income. It doesn't become a separate income and to be liable for GST. It still continues to be a discount. And most importantly, we need to understand whose sales are you promoting? Are you promoting your sale? Let us say when the Nestle has given Nestle says to Big Bazaar that you keep my chocolates near the cash counter, I will give you 10% incentive. So whose product is the Big Bazaar promoting? Is he promoting the product of Nestle? Is he doing the sales promotion for Nestle, or is he also doing his own self promotion? So let me tell you, to say that it is a sales promotion of Nestle is not totally a correct statement. It is actually our own sale promotion as well. So how can there be a self service or a self supply being taxable? So it is a condition for supply, and we need to delineate and differentiate between condition for supply from the consideration for supply. Very, very important that we understand this difference. And Circular 92 is something that one can refer for this purpose. So these are the things that we need to focus on when we are recommending any tax liability. Time of supply and place of supply. Again, time of supply, I'll tell you, there will be hardly an assessee who has complied with this. Somebody has paid later, somebody has raised multiple invoices in the next month, suddenly the interest implication will come. Somebody has reversed the input tax credit at a later point of time with no balance available. Again, on that reversal, whether the interest has been paid, we don't know. On advances, there is a GST liability as far as the services is concerned. That is another very important thing. As an auditor, yes, on a materiality level, you have to verify this. But department surely is going to look into all these things. So time of supply is one area that where interest implication can come for any delays. Place of supply is the heart of GST, if you ask me, because even if the assessee has made the payment of taxes, then as an auditor, you are still bound to tell him to make the payment of taxes again if the tax has gone to the wrong treasury. It was supposed to be paid to Karnataka government. It has been paid to the Haryana government. You cannot say that no, the tax is paid, so that it is over. It is gone to the wrong treasury. It has gone to the wrong department altogether. It is as good as non-payment, and there are options available. There is a law which says that either you make the payment and claim refund, or you just put this as a reporting in this thing, and whenever the department comes, you do the correction. But why wait for the department? As an auditor, you need to suggest these things, and if you have identified, you need to report these things. This is some very important issue which I will certainly discuss in the coming slides. Reconciliation, very important. Any liability that we are telling on account of reconciliation, one very fundamental, very important thing which I want to, each one of you to note is that do not recommend the liability of reconciliation without verifying the numbers of the subsequent financial year. For example, let us say in the 18-19 you have done the reconciliation and you have found that there is 10 lakhs of reconciliation difference which needs to be paid. Now, which is not paid in 18-19. But when you look at the 19-20 transaction, actually Audit has paid that in 19-20. It may be possible that he has actually paid that in 2021. Now you may say that, how do I check? Do you want me to check even 19-20 and 2021? I don't know, because see, we cannot ask associates to pay something which he has already paid. So ideally, if the client is aware, let's say, if most likely, if the same person is working at the client's will, he would tell, no, sir, this has been paid in the next financial. But if there is a change in the person, the new person has been appointed who don't know anything about it, and we also have just gone by just checking 18-19, and later we realize that it has been 19-20, and if client comes to know that this has not been verified by us, it may certainly lead to underperformance of our duties. So in my view, we need to put some reasonable checks, balances, and some basis where we really don't dig into the entire financials of 18-19 or numbers of 18-19, 20, 2021. But yes, there should be a system to smart way of tracking those things and extracting those information, if any. Debit notes, again, very important. The debit notes is one area which is going to cause a very, very, very big issue. Two issues I would like to point out as far as the debit notes is concerned is that whether the interest liability come on the delaying issuance of debit note. For example, the tax invoice is raised in the month of July 2018, and debit note is raised in the month of December 2018, increase in the value. So what could be the reason for this debit note? Tomorrow, whether the government will say that, okay, the debit note has been issued in December 2018, but the supply actually was made in June 2018. So the time of supply arises when the supply is made and the supply is June 2018, and you should pay GST based on the time of supply as per invoice. You may say, no, 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 sir, look at the explanation given in section 12, which says that only when the document is issued, the supply must be deemed to have been done. Now, this is an open issue. Entire automobile industry, where this debit notes, prospective price revision, retrospective price revision, increase in price, decrease in price is very common. And there are many other industries with this, very common business transaction, are carrying this risk. And if you ask me about the past, there are divergent Supreme Court judgments. Let me tell you, divergent Supreme Court judgments. For example, there is a Supreme Court judgment as recent as 2019, Steel Authority of India Limited, in case of Central Excise, where they have told that you need to pay interest. Now, if this interest liability comes, let me tell you, the automobile industry is going to badly suffer, badly suffer. So, but yes, as a part of GST audit, you need to at least caution client, you need to tell client that this kind of issues are going to come. I'm not saying that you need to ask them to make the payment where there are, largely this kind of interpretational issues which are there. But we need to certainly caution client, and we need to verify if there is non-compliant. But yes, if there is a particular issue where it is not because of any subsequent event, it was just because, it was short paid earlier under invoice, and later that was corrected by way of a debit note, certainly there will be interest implication which will come. Most important thing, or most important question that may come, another thing is that there was quite a bit of rate reduction in financial year 18-19. So let's say in the June 2018, when the original supply was made, the tax rate was 28%, and when the debit note for the same supply was made, the tax rate in 18%, and on the debit note you are paying GST at the rate of 18%. Now this will again be disputed by the department, because the tax rate has to be as per the original supply, whatever the rate as applicable when the time of supply attracts, which is 28%, which is there for. So these are the important things that needs to be verified. As far as the credit notes is concerned, again, the same issues would be there as debit notes. But very important thing in credit notes is also a time limit. We have seen even the large organizations where they have adjusted the 17-18 credit note in 18-19 after September 2018. So there was a bit of non-awareness where people were of the view that even the time limit to adjust by way of credit note also got extended up to March 2019. Answer is no. What was extended up to March 2019 was only the time limit to take input tax credit, but the time limit to adjust by way of credit notes never got extended. So if there is any credit note which is issued pertaining to original invoice of 17-18, and if the credit note is issued from October 2018 onwards, then it is not a correct adjustment under section 34, and we need to recommend those tax liability. Very important is change in tax rate. As I've already told, let's say 28% has become 18%, and let us say there is associated in a service sector. On the advances, when the advance was received, the rate of tax was 28%. And let me tell you, these are the live problems which we have actually seen in our clients. So when the advance was received, the tax rate was 18%, and the associate has paid the entire tax of 28% to the government, because that was the tax rate when the advance was received. But when ultimately the supply was taking place and the invoice was generated, the tax rate got reduced to 18%. So associate has done the respective changes in their ERP system and reduced the tax rate to 18%, and on the invoice, the tax rate of 18% has gone. So what has happened in the process? You have paid 28% taxes to the government, and what you have collected from the customer is only 18%. 10% of the tax you have paid out of pocket, and nobody in the organization is aware. Let me tell you, in all cases, wherever associates made the payment of tax on advances, these issues can come, and we should immediately ask client for either adjustment or going for refund in these cases. Very interesting thing which I would also like to highlight is on interest. Now, as far as the interest is concerned, interest for non-payment, short payment, all these things, you all must be knowing that recently there was this law got amended. There was multiple judgments, Madras High Court. Then there is in the past there was this larger bench tribunal judgment of JK Tires, and there are a few more landmark judgments in the service tax regime. As far as this interest is concerned, that's stating that interest needs to be paid only on the net value, which is fine, which is now looks a settled law. I'm not diving into that. But the problem again is going to come in the way in which they have amended the law. They amended the law, not with a full vigor. Now you see this particular provision. This is exactly the amended provision which I have quoted here. Provided that the interest on tax payable in respect of supplies made during a tax period and declared in the return for the said period furnished after the due date in accordance with the provisions of section 39. I would like to take a pause here. Provisions of section 39, which means this benefit is available only in case where the return is filed under section 39. As I've already told, annual return is a return under section 44, not under section 39. And as per department, annual return is under section 73. It is a self-assessment under section 73, which continues except where such return is furnished after commencement of proceedings under section 73 or 74. So as per department, this annual return exercise, what you are doing and self-assessing is a commencement of proceeding under 73. Or even if it is not a commencement of proceeding under 73, it is at least not under 39. And the benefit of net input tax credit would not be eligible when you are remitting money through the annual return. Is going to be another Pandora box of dispute. In my view, the benefit of net input tax credit should be eligible, for which I've already given a detailed submission in the earlier slides. Now looking at certain spillover transactions, since we are sitting in 1819, there is a spillover from both the sides. There is a spillover from 1718, there is a spillover from 1920 as well. Now let us look at certain important aspects. Delay in payment of tax. Now this was one of the common issues where say somebody has paid the liability of 1718 in 1819 and it is reflecting in the 1819 3B. So if you see the below table, it looks like as if the tax payable is 120 in financial year 3B of 1819, but the tax paid is 220. But that 220 is not like excess tax paid. It is basically the 100 rupees of the 1718 which was paid in 1819. So the question that comes is, sir, whether this also should be disclosed in the taxable value. Answer is no. And there is a categoric circular also released in this regard. You need not disclose all these things. See, we need to disclose only the details of transactions of 1819, which is as per the audited financials of 1819. Something which is not at all a turnover of 1819, just because you add back turnover in the original table 4. Don't do such things. Keep table 4 nil and let the tax payable and paid be shown as excess tax paid. You can give respective remarks in the 9C stating that there is no excess tax paid. This is a transaction of 1718 which was paid in 1819. There is no excess payment of. Similar, in case of excess payment of tax also, you just need to leave it open as it is. Just keep it open. The table is quite self-explanatory. I'm not going into explaining the same in detail. What I'm trying to say is that let's say an excess payment of tax 1718 which has been adjusted in 1819. Your form may show as if payable is 120 but paid is 110. Don't get panic. Leave it like that only. Let it be shown as payable 120 and paid 110, and give a remark that it has been already been excess paid which has been adjusted. Adjustment of the excess paid in the earlier financial has been done in this, and hence it is there. But this financial, everything has been properly paid. Like that, a proper remark can be put up. Now, this is one of the common issue: incorrect type of tax paid. Now, here I'm talking about incorrect type of tax paid. Type of tax paid. CGST, SGST was payable, but you have paid IGST. On the invoice, you have disclosed the details. Now, if you have corrected that in the same financial year, then yes, no problem. You disclose the correct details. You disclose IGST in your annual return. Let us say you have corrected that in the subsequent financial year. In that scenario also, I would always recommend that you disclose the correct details in the annual return. As I've already mentioned in the start, the guiding force must be what is correct must come. Just because something is wrong should not go wrong in the annual return. So correct is IGST, disclose IGST, make the client pay additional IGST. And since you are telling that it is already adjusted in the next financial year, 3B has already identified and he has already adjusted, you can show same adjustments in table 10 and table 11 with the details of tax payable in table 14 of GST 9, and that's there ends the story. There would not be any additional tax liability that will come because it is already adjusted in 1920. Now, let us say they have paid CGST, CGST instead of IGST, and that is not adjusted even now. In that case, as an auditor, we must ask SSTs to pay CGST as GST, and whatever we must ask them to pay IGST, we must disclose as IGST. Whatever extra CGST, SGST is paid, we need to ask them to claim refund, or the same can be adjusted in the subsequent returns. Now, the very important question that comes is that what is the difference between credit note, refunds, and adjustment? There are three ways in which we can take back the money from the government. One is credit note, other is refund, and third is adjustment. Now, let us say that the time limit for credit note is over, which is now over for financial year 18-19 at least. So let us say in the course of doing the GST audit, you noted that the client has made some excess payment of tax. He has made 1 lakh extra, 2 lakh. It's very much possible. We have seen in various clients in the first few years of GST, there has been tremendous issues and errors noted. So should you ask SSC to only go for refund, or can you tell SSC to just adjust in the next return? Now, my view here would be, if it is a mere arithmetical error or a mere numeric error, then you can certainly simply adjust in the next return. No need to apply for refund. So if there is 100 rupees excess paid, 1,000 rupees excess paid, 2,000 excess paid, 5,000 excess paid, if we keep on going and filing refund applications, it is absolutely lead to tons of applications, which we know it just lies with the department. And refund is refund, and it's like taking something out the mouth of the tiger. That is what exactly to take the money from the treasury of the department is like. Now we can simply adjust in the next return. What's wrong? And circular 36 is very clear. Circular 26 is very clear, which I have already explained, and which is also active today. But yes, if there is something on a technical front where there was an interpretational issue and all those things, why they are asking us to ask for refunds for any excess payment of tax, which is also not there. But in service tax law, there was a categoric statement under Rule 6.3 of service tax rules, where it stated that any excess tax bit can be adjusted in the subsequent period returns. That was the law, very simple. So why not, and let me tell you, there is no express provision in the GST law restricting this. This is very important thing that one can note. Now, incorrect type of tax charged. Again, I would say the view would more or less will be the same what I've already told in the previous slide. But here, the only difference is that there is an incorrect type of tax charged, wherein, on the invoice also you have charged wrong tax. So obviously, you need to actually give a corrected invoice to the taxpayer or the assessee. And if possible, make respective changes in GSTR1, which I think now their system is not allowing. Ideally, they should not keep all such restrictions, unnecessary things. But anyway, so in this, there is an additional option wherein you can either make an adjustment and make the correct payment of taxes and claim refund or adjustment of the wrongly paid taxes. And second option is that you just leave it as it is. Let the department come for audit. When the department comes for audit, you can simply make the payment and claim the refund of wrongly paid taxes. Adjustment of advances. In some cases, it is seen that the auditee has not adjusted the advances. They have paid the taxes twice. They have paid the taxes on advances at the time of issuance of invoice. They did not adjust that advance against this invoice and again paid the taxes. So it's a double payment of tax. So just because somebody has paid the double payment of tax, don't self-assess the tax liability also twice. Put only one. Either you put advances or you put invoice. Preferably, since invoice is issued, just put the details in invoice and report the tax liability only once, and let the payment details be very clearly showing that tax payable is 100, but what is paid is 200. And for the balance 100, we should ask the client to go for refund or whatever the adjustment which I've already told. So quickly, I would like to take you through the annual returns and 9C for as far as the outward supplies is concerned. Lot of information now they have relaxed. For example, entire information from 4B to 4F 4E can be simply given as on a net basis in 4B only. You need not give in each and every table. A few of other taxpayers or the professionals may not be aware. This is a relaxation which is there for financial year 17-18 and 18-19. This relaxation is not there for financial year 19-20 as of now. Similarly, here also you can just put your entire details in exempted, net of credit notes. You need not put in each and every column. Government told that at the time of audit they will ask you the details. Yeah, so this is the table 10, table 11, where you will be putting the details of what has been declared in the subsequent financial year, say 19-20. And here they have used the word April 19 to September 19. I would go ahead and say that even if it is after September 19, if something is paid, we might as well disclose here so that there is an adequate disclosure. We should always go for disclosure rather than non-disclosure wherever there is a doubt. So those details can be disclosed in 10 and 11. I'm not going into the detail of it because, in case there are any questions, I will take it. Table 14, again, whatever has been paid in a subsequent financial year needs to be disclosed. Coming to 9C, this is about the outward supply, what needs to be disclosed where in annual return. Coming to 9C, they have told that instead of disclosing in B, C, D, E, F, G, all these adjustments and bifurcating, you simply disclose everything in 5O, and that's all. Everything is allowed. Just keep the backup working papers with you and explain to the department whenever they come for audit. That is sufficient. Now, similarly, here also you can simply put the details in the exempt supply. That's sufficient. You need not disclose in each and every tab. This is a rate-wise breakup. If you ask me, one of the most complicated tables in the entire form. But yes, here we need to disclose the taxable value, which should be as per the proper auditor's assessment and the proper taxes, which needs to be paid. Reconciliation is required to be done. The ways and means of doing, I'm not getting into that because each approach can be different based on what is the client's ERP and how they are maintained the books of accounts, records, and all those things. But in the long run, we should ask assessees to maintain the proper ledgers with a proper rate level breakup in their books of accounts so that the 9.9C exercise becomes easy in future, considering this table. Any additional tax liability coming in, we need to disclose here. And yeah, so this is about various intricacies in outward supply and revenue transactions. So Chaitanya, do you feel that we should take queries now for outward supplies, or should we restrict our queries to the last? Anybody having any important queries to be taken up immediately?
There is one query from Mukesh sir. Sir, my client is doing works contract in Orissa for limited company. However, company is taking invoice from my client on Maharashtra GST number. Sir, whether it is correct, please guide.
The client is doing a works contract in the state of Orissa.
Yes.
And they are taking invoice for the company is taking invoice under the Maharashtra GST number with IGST, correct, na?
Yes, maybe this is the...
I'm assuming it is IGST, it is not CGST, SGST.
Yes.
Now, let me tell you, this is more of a procedural non-compliance, I would say, on the part of your client. Because this issue came before implementation of GST, where whether we need to take registration in each and every state wherever there is a works contract or a renting of immovable property service and all those things. Now, see, ultimately the money has to go to the Orissa government. That is something we are clear. The money has to go to the treasury of the Orissa government. If your client is charging IGST and the money is going to the Orissa government, we don't have any problem because money is going to the right government. But the issue that can certainly come is that tomorrow Orissa government can say that your client must have taken registration in the Orissa state of Orissa. For the simple reason is that you are having permanent establishment, fixed establishment with human resource or technical resources having a degree of permanence in the state of Orissa. If this is there, if there is a fixed establishment having a employees or other technical resources with some degree of permanence in the state of Orissa, then you actually have to take registration in the state of Orissa. So those non-compliances can certainly attract to your client, but as long as it is being charged as IGST and the money is going to the treasury of Orissa government. On the payment front, liability front, I don't see an issue. So I hope to have addressed your query. Any
Yes.
other things?
No, so far only one query. Mukesh sir, I have unmuted you. So I guess the query was resolved. Okay, so maybe there is some issue at his end. Okay, he has said the query is issued. We can go ahead.
Perfect. So now coming to intricacies in the input tax credit. Now again, input tax credit as well. We need to perform the reconciliation of ITC between books, computation sheets, and GSTR 3B. Actually speaking, this is where the real pain is. My team has told me that, sir, we are spending the largest amount of time in this reconciliation because outward supply, each and every person, each and every businesses have a very good control over their sales. Nobody, everybody would have, we may monitor our sales on a monthly basis, weekly basis, quarterly basis, and all those things. And purchases, expenditure gets an ignored area. So, the kind of entries in which the kind of the way in which the entries are passed in the books of accounts and all those things, it was tough job for the team to do the reconciliation of input tax credit. But one very important question I would like to throw is that let us say there is a issue where the assessee has taken input tax credit in 3B, but it is falling in a reconciliation difference, and they have actually not recorded that entry or not recorded that details of that credit in their audited financials or in the books of accounts. Because of that, would you ask the assessee to pay the taxes, or would you recommend the additional tax liability? In my view, answer should be no. Because just because an accounting entry is not passed in the books of accounts, you cannot say that the input tax credit has not been taken. You have rightly taken the credit which has been disclosed in the 3B, and it is just a procedural error of not accounting in the books of accounts, and that should not lead to a tax liability unless it is a capital goods where you have actually capitalized the tax element and taken depreciation. Then there is a restriction. Other than that, I think you should not worry much. Another $1 million question that comes is, sir, what should we do with the 2A 3B reconciliation? So again, I would say, I can actually say this in this webinar as well, just ignore, because this is nonsense. 2A 3B reconciliation is absolute nonsense, especially for financial year 18 now in 19, where the law itself is not at all in place. And let me tell you, this will be quashed. This has to be quashed. Go with the books of accounts as long as the conditions in section 16, subsection 1, subsection 2 and 3, all those are satisfied. Just take the credit, and of course you should keep the 2A reconciliation. You must perform the 2A reconciliation to understand the exposure difference, the reason for difference. It may be possible that in the course of doing 2A reconciliation, you may come across some genuine reversal which needs to be done. That is certainly an exercise for which you need to do a 2A 3B matching and all those things. I'm not saying it don't do the matching. You have to do the matching. It has to be thoroughly done. There is very recently this Ranganatha Valves Private Limited in the course of Madras High Court. This was in the context of the Tamil Nadu VAT, where they have held, and similar in the case of Delhi VAT, in the case of Arise India, where they have mentioned that merely because supplier has not filled the details, you cannot make the recipient pay the tax. More specifically in Arise India, it was told that it is government's responsibility to put the system in place. When the system is in place, you cannot expect an assessee to be, suffering for the same. Or I would like to give you one beautiful example, which I've already given, earlier. If you have heard me, you might have seen me saying this. Now, let us look at this on a practical basis. Let us say there is a transaction of 1 crore on which there is a GST of 18 lakh rupees. Now that 18 lakh rupees, you have the supplier has raised an invoice, but the supplier has not paid the GST to the government. And say that 18 lakh rupees, you have taken the input tax credit as a recipient. Now, government says that no, supplier has not disclosed in GSTR 2A, and you please reverse your input tax credit. Okay, you told, I will rely, I am a tax, abiding assessee, since it is not reflecting in 2A, I will reverse the ITC. Now you have reversed the ITC of 18 lakh rupees. Do you think, I'm sorry, do you think that just because you have reversed the input tax credit, government will not claim that money from the supplier? Answer is no. Even though you have reversed the input tax credit, government still holds the right, and whenever they are going to do the audit, assessment, adjudication, or whatsoever, and it may be possible that without audit, the supplier himself later, once he has money, he may pay the taxes. Now what is happening? Now on the same transaction, there is an 18 lakh rupees which the government will claim from supplier. On the same transaction, government has asked the recipient to reverse the 18 lakh rupees as credit, and from both, government is asking interest. So already the implication is 36% with interest and penalties. The implication can go to 60%, 70%. Now in this entire circus, assessee is paying twice on the same transaction, and with interest and penalties, the tax liability reaches up 60, 70% or 50, 60% of the taxable value. Which country are we living in? Which country are we living in if we are being asked to pay 36% of tax by combining both supplier and recipient on the same transaction? Absolutely absurd. And let me tell you, it's just a matter of time when this will be quashed. It is just the strategy is very simple to not to clarify, so that in the course of fear everybody complies. And unless there is one assessee who takes the no, I will fight and I will take this to the courts. So, but of course, as a country, we need to change this kind of systems. I think lessons of the past are not being learned. I really don't understand why our tax laws cannot be simple. Why this kind of unnecessary consequences and compliance? Why these restrictions? Why these restrictions? This is an indirect tax. Indirect tax, there has to be seamless flow of credit. And let me tell you, the time limit of this September 2018 or September 2019 or September 2020 to take input tax credit will also fall flat. For example, there is an assessee who is not paying the taxes because he is not having money, or he is filing the return a bit late, and by then it is not reflecting the other person's 2A. Is government giving us in writing that yes, we will not demand the money from the supplier? Had it been GSTR 1, GSTR 2, GSTR 3, everything was online. But you never implemented GSTR 1, 2, 3. Today, everybody is in black. And by keeping everybody in black, you are saying that I will ask the recipient to reverse and I will also take the money from the supplier. I don't know whether the finance ministry is aware about this kind of issues. And when we say that, why our economy is facing problems, these are the reasons. When somebody is being asked to pay 36% of tax. So the point is that this section 16(4) is itself is not a correct provision. This entire thing of time limit of taking credit started only in 2015. Earlier, there was no time limit to take credit in the indirect tax law, at least in the excise and service tax. But I think any indirect tax structure, even if there is time limit, it has to be some reasonable time limit. It cannot be like something which is just 6 months time. Similarly, for example, bill of entry. Now, if you strictly read, even if I read 16(4) on a strict interpretation basis, bill of entry, there is no time limit for imports. So, for example, it says invoice or any other document. Now, any other document, when we look at it, it only covers whatever the invoice. It never covers bill of entry. So, when you are importing, it also doesn't get reflected in 2A. I don't know whether it has started now. But at least for financial year 18-19, there is no time limit to take credit for imports. And this is exactly what the strict interpretation. I'm going with a strict interpretation of section 16, subsection 4 of the GST Act. Credit avail in the different GST number. So say associate having multiple GST and she has taken credit in one instead of the second, can lead to problems. Impact if it is leads to reconciliation difference. I've already talked about that. Just because of the accounting entry cannot lead to any additional tax liability. If the tax has been paid in a different POS, for example, it was supposed to be paid. The credit was supposed to be taken in the state of Maharashtra, but it has been taken in the state of Rajasthan. Now, let me tell you, we should not just look at it from a CGST, SGST point of view. We are of the view that as long as it is IGST, you can take the credit. Answer is wrong. See, even IGST has a place of supply. Now, IGST of Maharashtra is different from IGST of Rajasthan. IGST of Rajasthan is different from IGST of Haryana. So if you have taken any per goods where it is IGST, but if the IGST, the place of supply is Rajasthan, you cannot take that IGST in Maharashtra, because it is like Maharashtra government is taking the benefit for the money which has gone to the Haryana government or Rajasthan government. Absolutely absurd. So this is also something we need to put in our checklist. Very important. As I've told you, certain details are made relaxed, so you can simply put the, you need not punch the entire details. Then ITC of 1819 booked in books but claimed in GSTR 3B of financial year 1920. That will get disclosed in the financial year 1920. It will never come in the financial year of 1819 because you need to go as per 3B. Input service capital goods breakup is not required. You can simply give the complete details at once in inputs. But the breakup is important for the purpose of refunds and ITC reversal, because the law is different. Refund is not eligible on capital goods. All those things are important. Then this Rule 42 reversal is extremely critical and extremely important. This is something where we can also add value to the client. We need to see what is exclusively used for taxable, assessors must be given full ITC. What is exclusively used for exempt, they should not take ITC. And the only balance which is absolutely common, only that you need to apply the Rule 42 and Rule 43 and reverse, ask the assessor to reverse the credit, basically in a scenario where there is both taxable as well as exempt supplies. Now let me tell you, there also there is a benefit. One needs to look at the capital goods. In case of capital goods, let us say initially you were exempt and later you became taxable. So the depreciation to be claimed over 60 months. So let's say if already 2 years are gone, 24 months are gone, but for the balance 36 months, you can actually ask the assessor to take full input tax credit. Very important. Then these are certain credits which are restricted. I'm not really going into the discussion of detail of it. Each of these restrictions have lot of interpretations to be discussed. I think we may fall short of time to really dwell into each one of it. There can be a separate session only on the issues where we can talk more. But yes, there are a lot of value addition which we can give to client once we go into the detail of our interpretations in reversal of credits. We need to be very mindful of what we are asking client to reverse, because if tomorrow any favorable judgment comes, it may lead to incorrect interpretation from our side. Education says there is a divisional high court, divisional bench of high court in the case of Madras High Court. They have told that this is not eligible, the transition is not correct, and in case any assessee is taken, you need to ask them to reverse the input tax credit. 180 days reversal on a materiality basis, we need to do this verification, and if there is a largely materially impact is there, yes, we need to ask the assessee to reverse if the payment is not made within 180 days to the supplier. But again, over there also there is an interpretational issue, because the law uses the word failure to pay, fails to pay. Now, fails to pay comes when there is an obligation to pay. Now, when there is no obligation to pay, can there be a failure to pay? For example, in case of a tooling transactions in automobile industry, in case of this, retention money in case of infra real estate sector, where the condition itself says that you need to pay at a later date. So once the condition itself says to be paid at a later date, once there is no failure to pay, where is the question of reversal? So these are the important things that we need to consider when we are asking assessee to reverse any input tax credit. You all must be knowing that from 1st of February 2019, the ITC, the law got amended, and they told that wherever it is an obligation, credit can be availed by the employer. So canteen related things, wherever under Factories Act, the obligation is there. And let me tell you why we are restricting our interpretation only to Factories Act. Why not Shops and Establishment Act? So let us say in the Maharashtra Shops and Establishment Act, which got amended in 2018, and the rules thereunder, there is also a provision which says that mandatory food to be provided after a particular limit. So if that particular provision is there, then why not we claim a benefit even for shops and establishment service industry and other than canteens as well, where it is an obligation which is there. And the transitional details where anybody has taken credits in financial year 18-19 needs to be disclosed in a proper table. This is another very important issue where assessee has taken incorrect type of credit. He has got the bill of CGST, SGST, but he has taken the credit of IGST. He has got the bill of IGST, he has taken the credit of CGST, SGST. Now the problem is that no, I will reverse the incorrect credit. But the time limit to take the correct credit is over. So in the process, I have lost the entire thing. I think it is again an absurd and a vague way of interpretation. Very recently, there was a writ petition filed before the High Court for which the judgment has also come, where on the merits itself, on the Sunday chemical, they have told that what is being done is only a rectification. You cannot say that the time limit for rectification is over and we will not allow you the same, exactly the same issue. And this is also takes cue from the Bharti Airtel judgment, which I've already referred earlier. So in these cases, my suggestion will be to disclose the correct credits, and whatever the wrong credit has been done, make an adjustment, make a rectification in the return to be filed now, in the monthly return to be filed now, and show the correct credits in the return. Don't take the cost. Don't take the cost of credits just because the time limit is over and all these things. This is all will be quashed. This is how you need to disclose the details. As I've already mentioned, everything you can disclose in inputs. They are saying it is okay. So there's a lot of relaxation as far as the disclosure is concerned. Then here also, you can simply disclose everything at once. And again, depends on how you have disclosed details in GSTR 3B. You can directly disclose the net in the above table itself. You need not disclose here separately. Unless you have some additional reversals coming and you want to show it separately, the choice is given to the associate. 2A, I've already told, largely to the extent possible, try to give the compliance. They have also mentioned that if you don't want to put in this table and you feel that you have already done the reconciliation, so you can upload one PDF document signed by the client that this is our 2A reconciliation, which is we don't want to give in this format, which is also fine. They told it is okay. Table number 12 and 13 is optional. So I think we should take a benefit or advantage, at least due to paucity of time, if you're not able to do, or due to paucity of the way in which due to mechanism of the way in which the information is being provided or made available by the client. And focus can be more on the technicalities or the important things of doing GST rather than a form filling exercise. This is exactly the reconciliation between ITC and this thing where the details needs to be given. Spillover transaction needs to be given in table B and table C. I'm not going into the detail of it, but this table is not optional. Table number 14 is absolutely optional. This was one of the worst, information that was asked, especially the expectation in 1718, where hardly anybody has maintained in this manner. But if it comes in 1920, it is going to be a very big pain, which even today we don't know how to disclose the details over there. But luckily for 1819, this is optional. And let us now look at intricacies in reverse charge, and then we go into the other part. And then probably I would like to give another at least 10 to 15 minutes for questions as well. So reverse charge. See, one important thing is that nobody would at times associate may not miss out on paying tax liability on their sales, because there is a good control, good system. Similarly, they may not miss out on taking credits because it's a hard money. But the compliance issues largely are seen in the area of reverse charge, where these are the various transactions which are liable under reverse charge. Let's say GTA, ocean freight. Ocean freight, we have a Gujarat High Court judgment which states that it is not liable. The levy is unconstitutional. Levy is unconstitutional. And let me tell you, it is unconstitutional. And don't push clients to pay on ocean freight, because we need to understand that the judgment is a beautiful judgment. It gives 8 reasons why it should not be taxable. So when I was interpreting the law, I could at least think of 5-6 reasons, but I was surprised when I read the judgment. There were so many thought process that was brought in the judgment by various arguments taken. And I'm quite convinced that this ocean freight will be quashed even at the Supreme Court level. And department is also considering whether they want to amend the law on ocean freight. So GTA and all, there are a lot of issues over there. I'm not getting into the issues because each of these entries can have various issues. For example, directors, there was a lot of issue on whether we should pay or not. Finally, there was a circular stating that it's not required to be paid in case of a employee director. Security services is one important thing I would like to highlight because that got introduced only in 1819, which was not there in 1718. And that is where we have seen that a lot of clients have done a non-compliance in paying GST on security services, something that can be an area of focus when we are verifying the transactions of reverse charge. Details of taxable value needs to be disclosed as per a proper audited books of accounts, not as per 3B, as per our verification. What if the supplier has already paid, and should we again ask the recipient to pay the taxes? In my view, uh, ideally, the tax liability actually arises on the recipient. So first of all, we should ask the supplier not to make the payment of taxes and at least going forward do the corrections. But in the past, let us say if the supplier has made the payment of taxes and asking recipient to make the payment of taxes again leads to unnecessary interest cost or at times even a cost of the credit itself. uh, One can take the basis of judgments in the past where they have told that if the tax liability is already paid by supplier, recipient need not pay. There's host of judgments by various tribunals in the service tax regime. One can look at taking those benefits. So from unregistered vendors, it is not there in 1819, except for those builders where that 80% this thing is there. That I think that also started only from 1st of April 2019. So I'm not going into the entry by entry discussion because I know there is a lot of things, a lot of issues that we can discuss. But today's focus, I would leave it only from the audit perspective. I would say that as a taxpayer, as an auditor, we need to look at all the expenses as per the books of accounts, thoroughly review those expenses, and then form a view whether or not any tax liability payable under reverse charge has been missed out. Very important. We cannot simply go by 3B. We need to dive into the books. One very prominent question or very important question that comes is, sir, what if reverse charge for financial year 18-19 is now we are disclosing whether we can take the input tax credit? This is a very important question which has been asked. In my view, for financial year 18-19, if you are recording the tax liability now for an assessee, yes, there is a possibility to take the input tax credit now also, because now I would like to break up the entire reverse charge transaction in two categories, where the supplier is unregistered, where the supplier is registered. Where the supplier is unregistered, the law itself says that the self-invoicing needs to be generated by the recipient. Now the time limit for anything comes only from the invoice. And what is invoice? Invoice is only with a self-invoice. So when I'm generating the self-invoice only today, where can there be a time limit which is already over? There is statutorily, if you read it, which document should I see? Should I see the document of the supplier, which actually don't have any relevance? And it's only self-invoice, which has been you have recognized as a legitimate document. Now, therefore, the credit should be eligible, even today. Now, the second category would be a scenario where the supplier is registered and he has given a proper invoice, tax invoice. Of course, he has not charged taxes because it is covered under reverse charge. Now, even in those scenarios, in my view, that the service tax law was on a much, much better footing from an objective-based interpretation, where how can somebody be asked to do unexpected? How can somebody be asked to do unreal or something which is impossible? So when assessee is paying the tax, only at that point of time, the chance, the timer or the time limit restriction of taking the credit starts. So as long as it is a self-assessment, the credit should be eligible even in the second scenario as well. So in cases where the transactions are not material, you may take a decision even not to dispute into these lines. But where the values are high and the transactions are material, I would certainly say give it a shot. For a simple reason that it could be possible, and it could very much be possible that you get a favorable judgments on these things in future. As I've already told, the 16 for limit itself is going to come under the big time questioning of the department. And of course, I hope they don't retrospectively amend law, which has become quite a trend. So these are all the information which are optional, and you need not even disclose. This is again for financial year 18-19 HSN details, refund details, and all these other details. Now coming to very important subject of reporting and certification. I would like to take 10 minutes on this, and then probably we'll be done and we'll take questions for another. Maybe we may shoot up 5 minutes beyond our time. Now, the very important question that comes is, what is the role of GST auditor? What is the role of chartered accountant? What is the role of professional in the course of doing this GST audit? Do we need to do 100%? Do we need to do valuation? You have told you need to do valuation, classification, you need to go into books and all these things. On the other hand, there is another view coming out that it is only a reconciliation exercise. You need not go beyond reconciliation and all these things. So I will tell my view, and I have reasons and the logics to justify the same. And now, when we look at the meaning of the term audit, which is given in the section 2, subsection 13, just give me 1 second. Thank you. So when we look at the meaning of the term audit, it is quite vast. It says examination of records, returns, other documents maintained, furnished under this law or under any other law and all those things. So, one may say that the meaning of the term audit is very, very wide. And just because the meaning of the term audit is very wide, GST audit also very wide. Then there is another argument which has been told, sir, why are you telling it is a GST audit? It is a GST certification. It is not an audit. It is simply a certification. So why are you telling it is an audit? Then there is another counter. How will you certify unless you not audit? So you have to audit to certify, correct? So this is, I would say, multiple views that are going among the, professionals. Now, leaving aside the definition of audit under 213, I am not going into that, because once we go into that, then the view becomes very simple that, you need to verify everything. But I'm leaving aside the definition of 213. Section 35, subsection 5 says that every registered person whose turnover during a financial year exceeds the prescribed limit shall get his accounts audited. Accounts audited. Now here, in my view, the interpretation is not actually doing the GST audit or filing of 9C. Here, what it says is to get the accounts audited. Accounts audited means to get the books of accounts audited. Let us say, for example, if there is any assessee who doesn't get the books of account audited even while the turnover is 2 crores or 5 crores, and there is no mandatory audit either in the Companies Act because it is not a company, or let us say because they have only a certain category of income under Income Tax Act which doesn't fall in the audit bracket, and hence the books of accounts are not audited. So it is that books of accounts auditing of books of accounts which is being contemplated, and that's why the word accounts is very important before the word audited. So he need to get his accounts audited. How can you do the GST audit unless the accounts itself are audited? How can you certify a reconciliation unless the GST accounts are audited? And then it says that and shall submit a copy of the audited annual accounts. That is the audited annual accounts. The reconciliation statement under subsection 44, subsection 2. Now coming to the 44, subsection 2. Now basically this reconciliation statement is also coming in 44.2 only with the annual return. And what is coming in 35.5 is the auditing of the accounts. Now every registered person who is required to get his accounts audited under 35.5 shall furnish electronically the annual return under subsection 1 along with a copy of audited annual accounts and the reconciliation statement. Now here it is very important. The wordings which I have highlighted and the reconciliation statement, comma, reconciling the value of supplies declared. So what is being expected is only a reconciliation. Reconciling the value of supplies declared in the return furnished, and it says and such other particulars as may be prescribed, and such other so there are going to be some other particulars which can be prescribed. And let me tell you, government has prescribed some other particulars also, which I will tell you what is that. Now there is a press release which was issued on 3rd July which also says that the role of chartered accountants, their role is limited to reconciling the values. Now reading this entire conundrum of various sequence, 35.5, 44.2, this circular and all those things, I would agree with the point that role of auditor is only to the extent of reconciliation. But my 2 points I would like to raise is, are we doing only 9C for the clients? In my experience, what the assignments in which we are taking the assignments of the clients, we are taking a bundled supply. we are telling we will also support you in reviewing your annual return, which is GSTR 9. And we will also sit in the shoe of auditor and do the reconciliation statement, do the certification. Now, once we have taken the assignment of review of the annual return, then we have actually casted a responsibility on us to make sure that the annual return is correctly filed. Now, how do we make sure that the annual return is correctly filed? We need to look into the books, we need to go into the details, verify everything, and make sure that the self-assessment in the annual return is correct. That is where the role of the auditor, the role of a professional, the role of a consultant is getting widened, because this service is being offered as a package of verifying of GST 9 with the reconciliation or certification of 9C. Till now, there is nothing that has been objected upon this particular thing. Now, coming to this is exactly how even in Maharashtra VAT and other VAT laws this used to be done. Now, coming to another very important aspect is that you restrict yourself to reconciliation, but as an auditor, you need to carve a difference. Say, when there is any tax liability which needs to be paid, which is on account of reconciliation, there you need to recommend them to pay that tax liability. There cannot be any ifs and buts over there. There cannot be any interpretation over there, and there cannot be you signing the form, giving a true and fair view or true and correct view with somebody not even complying with the basic reconciliation. So there, there is zero tolerance. Now, coming to the similar other aspect of, let us say, valuation is incorrect, classification is incorrect, and all those things are incorrect. Government is asking you to give those details also, and that is where I take these words in 44.2, which says that, and such other particulars as may be prescribed. If you see the part B of the form, it says whatever you are certifying to be true and correct, whatever you are certifying to be true and fair, do you think it is true and correct and true or fair, or do you have any qualifications, any reservations, remarks, observations to be given? You have to mention that. It has been specifically asked. The information, the other particulars has been prescribed. Government is asking whether the assessee has maintained the books of accounts, documents, records. Now that is also specifically been asked in the part B. So if you see, the part A is the reconciling the values of supplies declared, yes, but it is a part B which is expanding the scope, where it says other particulars as may be prescribed. And that is where, even if we don't recommend the liability numbers, we need to put the remark in the part B. That is for putting the remark, and to say that, whatever I'm certifying is true and fair or true or correct, I need to get into the books and see whether there are something which is, pervasive, or something which is material enough to, say something not being true and correct or true and fair. So this is, now let me tell you one very fundamental thing is that we are thinking that, now this true and correct got changed to true and fair, so we can be adventurous in signing 9 and 9C. Answer is no. For a simple reason that true and correct, today the 9C is a combination of both. When you look at the part A, it says true and correct. And when we look at the part B, it says true and fair. So basically it has both true and correct and also true and fair. Now, as far as the true and correct is concerned, it is also correct, because reconciliation, there cannot be fairness. Reconciliation is reconciliation. Reconciliation is like 1 + 1 = 2. There is no interpretation. There is no question. So government is expecting 100% verification. The circle has to be completely closed as far as the reconciliation is concerned, and we need to certify true and correctness of the reconciliation. As far as the other interpretational aspects are concerned, they are asking a true and fair view. So, which is also absolutely fair. And that is where they are telling it is the opinion of the auditor. Let me tell you, opinion of the auditor. That is where your interpretation, your judgment, your understanding of the law is going to play a lot of importance. So this is what I've tried to explain in a bit more detail. What is the difference between true and correct, true and fair? What is the difference between observation and qualification? Qualification is something which is adverse. Observation can be a simple remark which need not be adverse. Now, let me just try to put it in a simple nutshell. Let us say the difference or issue is on account of reconciliation. If something is material, If something is on account of reconciliation, you need to disclose in part 5 and you need to quantify and make sure that the assessee makes the payment. If the assessee is not making the payment of taxes, which is on account of reconciliation, then you need to put this remark in the part B. Or if it is material, and you need to put the remark in the part B. Even if it is not material, the remark needs to go in the part B. Most important is that if something is pervasive of the financial statement, well, let's say you in the course of doing audit, forget about the materiality. You started realizing that whether I should really trust the audited financial statements, the way in which information is being maintained, you actually cannot do the audit. So then actually speaking, you cannot even sign true and fair with qualifications. You need to say that it is not true and fair. Actually, the form has not given the blank over there. It says true and fair with qualifications. But what about a situation where it is also not true and fair? It is absolutely, you cannot even say to be fair. So there, you need to give a specific remark that it is not true and fair, or you need to, abscond, or you need to, you need to resign from the assignment or whatsoever. Now, if the difference is on any other aspect which is not on account of reconciliation, my view is that don't get into quantifications. You should certainly tell to assessee to pay, recommend the assessee to make the payment. If they pay, well and good. Largely what we have seen, 95% of the assessees, whatever we recommended, they have made the payment, because we have explained them why we are saying what we are saying. And we have explained them that this will lead to a future problem if they don't make the payment of taxes. So, but where the assessee is not making the payment despite you are of the view that it is taxable, even if you don't put as a recommendation in part 5, you don't quantify it, you have to put this as a remark in the part B if it is material. If it is immaterial, you can also take a judgment of not putting the remark. But if it is material or if it is pervasive, you cannot sign. Or you need to say it is not a true and fair view. But if it is material, you need to put a remark in part B. Now, this is what exactly, can be various things on which how you take a decision. I'm not getting into. In part B, you need to put some assumption safeguards if you feel that some assumptions are important. For example, now this is a COVID time. You may like to put that the entire audit has been performed on a virtual basis without verifying the physical records and documents. A simple safeguard, which is also the reality. Or the law requires you to comment upon the accounts, records, and documents that have been maintained by the taxpayer. So that also needs to be verified and needs to be seen whether it is proper or whatever. And then let's say there is an interpretation. Let us say, for example, ocean freight. And wherever there is an interpretation involved, where as per you it is taxable. If as per you as an auditor, as an individual auditor, as per his professional judgment, it is taxable, then if the assessee is not paying the taxes, he need to record in the part B, because as per that professional opinion of that assessee, it is taxable. Or let's say as per the professional opinion of the assessee, it is not taxable. Let us say ocean freight. When I read the judgment of Gujarat High Court, I am convinced that it is not taxable. And if the taxpayer has not made the payment of taxes, I need not record that in the part B, or I need not put a remark in the part B, because in my professional judgment, my professional opinion, it is not taxable. We might as well put one general remark stating that wherever there is a multiple interpretation involved or the divergent views being taken, we have not recommended the tax liability. As simple as that. And I don't think there should be any wrong done from an auditor's point of view, because this is an opinion which is also needs to be given. As far as the interest and penalties are concerned, if the penalties are specific in nature, certainly you need to ask the assessee to make the payment. If the payment penalties are general in nature, procedural in nature, a professional judgment can be taken whether or not you should recommend. And as far as the interest is concerned, there is no saving. Interest needs to be paid. If the tax liability arises, interest arises, and interest has to be paid. So this is very important from the quantification perspective. Ask the assessee to even make the payment of interest. If somebody is not making the payment of interest, then you can put an appropriate remark in part B, unless you feel that interest is not payable as per your professional judgment or opinion. Where you are not able to form a proper professional judgment or opinion, it is suggested to ask client to take a proper expert opinion or take an expert view and keep a documentation of the same, so that these things can be justified at a later date. It need not be an opinion on a technical nature of law. It can be on any aspect. Let us say there is a particular product where you are not sure, whether the classification will be here or there, depending upon the chemical composition or whatever. You would like to take a opinion from a chemical engineer. So that is what something very important. Accounts, records, documents, these are the various things that needs to be looked at. There should be a specific list. There are some non-compliances in cases of generating self-invoicing, receipt voucher, refund voucher, and all these documents. So a professional judgment and a view must be taken as to the materiality of this non-compliance, and accordingly it must be reported. But this particular information, they specifically asked for reporting. So if it is not complied, it must be reported. So with this, discussion, I think it's got 10 o'clock that, we are concluding. I would like to, be sorry for, delaying about 10 minutes of this discussion, but certainly if the, time permits, which Chaitanya must say, we can certainly take questions. I would like to take questions for maybe 10-15 minutes.
Yes.
I would like to thank Chaitanya for the coordination, and Pune Camp CP Study Circle for giving me this opportunity to put forth my views. Thank you all for patience listening.
Sir, there are few questions. So the first question is, can I avail SGST credit of services availed in other state, that is services availed in Goa and registration is in Maharashtra?
SGST, CGST and SGST credit, is it?
Yes.
See, again, over there, I would say no. There is a particular view that has been stated that even forget about CGST credit, even SGST credit of the other state can be taken, which view is being pronounced based on more of the fact that GSTR 1, 2, 3 has not been operationalized, and the meaning of the term state tax and all those things. But even looking at an aggressive view, if we have to take, I would suggest no, not to take the credit of SGST. That would be too much of an aggressive view, and it may go against an SSE. So my view here will be no.
Okay. The next question is, what is the GST rate for works contract of construction of single residential bungalow? Is the rate if the rate will be different for interior work of single residential bungalow?
I would like to abstain from answering this query for a simple reason is that this tax rates and all these things are very technical matters, and there was as far as a works contract is concerned, the pure services, there is an exemption if it is a pure services for a single residential this thing. But if it is a works contract, you are saying where it involves both goods and services, it again depends on the square feet and all those things. The law has got changed multiple times over there. But if it is residential, depending upon square feet, it is 5% or 1%. And if it is flowing from back, there is also that 12% category which is also there. There is some disturbance which is coming.
I'll just check.
Yeah.
Hello?
Okay. So yeah. Now, as far as the interior works is concerned, in my view, again, there also, depending upon whether the main person is he under affordable or under the regular category, the tax rate would change from 18% or to 12%. But this is something I am answering without verifying the records of the SSC or the relevant agreements. So generally, I abstain from answering the queries, especially relating to the tax rates, because tax rate, in my view, is the most complicated exercise. And my suggestion will be, you also go through the notification number 11/2017 independently yourself, read with the respective explanatory notes which are there, read with the scheme of classification which is being given, and accordingly take a informed view on this matter.
Okay. There is one more question. If rate for output service charged is 12% instead of 18%. Till what time debit note can be issued, or if related to 1920, can it be rectified in September 2020 return for 1920?
There is no time limit for issue. The time limit is only there for credit note. So even now you can issue a debit note, and so the customer can take the input tax credit. As far as the customer taking the input tax credit, the law has been amended in this regard, but it has not yet been made effective. So once the law becomes effective, then the customer also can take input tax credit. In my view, it is also not correct of they're not making the law effective. It is like government is amending the law, which was amended in financial year 18-19 budget, and that has been not made effective till now. And just they have to pass a notification. But in GST law, the amendments making effective to each amendment itself is becoming a big task, because it has to go through all the states and all these things. So customer taking the credit can be a question mark even today, because although amended, it is not effective. The notification is not yet issued. But yes, you can, there's no time limit for debit note.
Thank you, sir. Sir, last question. An assessee who is in the business of transport of goods is currently paying GST under forward charge. Can he switch to reverse charge regime? If so, what is the process? Can he do this switch over midway in 2021, or he can switch only in 21-22?
As far as this transportation reverse charge is concerned, certainly we can switch over in the middle of the financial year as well. There is no intimation to be given. There is no restriction that once you have adopted, you need to be in the same category for the entire financial year. There is nothing like that. And only thing is, we are suggesting the taxpayers to better to intimate to the department, so that intimation is always to be chosen over non-intimation. But there is nothing needs to be updated on the portal or the online or anything like that. They can simply switch. Very important part here is that the rate of tax would change to 12% in that case, in case of transportation. And the most important part is that they can take the credit of capital goods. Let's say if they have purchased trucks, and the trucks were purchased in 17-18, which they have not taken the credit. Forget about the depreciation of 2 years. Remove the 24 months ITC, balance 36%, about 2/3 of the ITC you can still avail as on today, which is a beautiful value addition. So I think a lot of transporters are choosing for this option, and something that can be looked at. Yes, they can go even now, in my view.
Last question. Whether we can claim ITC on construction of factory building?
On construction of factory building, I would say, again, as far as, see, the thing is that it is easy to say the word construction. Now, I would like to ask, what is the meaning of the term construction? Government has only told that construction includes what is capitalized to the immovable property, but that is only an inclusive definition that is given in a particular context where you do the renovation or something after original construction. But what is construction per se? That is not been defined. It is given an inclusive definition in the law. So now let us say, when there is a particular building to be built, there is a lot of activities which is done pre-construction. There is a lot of activities which is also done post-construction. The question that comes is whether these activities also fall within the gamut of the term construction, because what is restricted is only construction. Now, for an example, in my view, where there is a excavation, earthwork, or land leveling, or demolition, is it construction or is it pre-construction? In my view, this is pre-construction. This is not construction. You're not started. Although in a general parlance, we may call it as it is under construction. But still, when we go for strict reading, it is actually pre-construction activities. Now, only once the plinth is been there, and when you actually build a particular building, and with a proper civil content going into it, with proper bricks and mortars, that is what is construction. where you are constructing, you are building, that element, the credit will not be eligible. Now coming to the post-construction activity, which was actually in service tax law, there was a separate service called completion and finishing works. It was not called as construction of complex. It was called as completion and finishing works. Now, what are these works? Tiling, painting, waterproofing, all your interiors, all your POP works, all your, various windows, panels, and all these things. Are these not post-construction, or should we tell these are also construction? Now, from up to where we should stretch the meaning of the term construction? I will give you an example. Let us say the company who is doing the construction, they may also take a bill of a consultant, an auditor. Is that also for construction? So we need to restrict and understand what is the meaning of the term construction. There is something called development, which is a wider meaning. Within development, there is construction, which is one element. So in my view, construction element, pre-construction and post-construction activities, the credit should be eligible. And within the pre-post construction activities as well, there are a lot of things which are like windows, panels, doors, furniture, fixtures, equipments, which would actually be covered within the ambit of equipments or plant machinery, all these things, which was anyway, the credit should be eligible for them. So this is what is my view on this aspect. You are on mute, Chaitanya.
So that these are the only questions we have received. So I guess we can stop here. So once again, thank you so much, Ravi sir, for your amazing insights. As you first said that you would like to meet physically, even we are very desperate to go into physical meets at Hotel Shantai because अभी ये virtual बहुत bore होने लगा actually. But looking at the situation, we have to go with the virtual thing. And once everything come back to normal, even we would again switch back to the physical meet. And even ICI has allowed the physical meet. We are just waiting for the situation to get normal so that we can start our regular meets. Then also you said about the HSN code. Like there are many cases where the HSN codes are wrong, and whenever you ask clients, client says कि हमको जो आया है वही हमने आगे पास ऑन किया है, and the chain will pass on, गलत गलत होते ही जाएगा. So as you rightly said, and even the credit note issue, people are interpreting wrongly that it has been extended to 31st March 19, whereas it is up to 30th September, as you said. So thank you once again. And एक चीज सर, जब दोस्तों से बात करते हैं तो रोज फ्रस्ट्रेशन निकालते हैं कि ये क्या कर रही है गवर्नमेंट, बट आज जब स्पीकर से खुद से सुन रहा हूँ कि नहीं गवर्नमेंट गलत कर रही है तो एक सुकून मिल गया है.
No. See, I am not saying government galat kar rahi hai. There are a lot of things which the government is doing right, but where something which could be done better is something I think somebody must raise a voice, and I am just doing that. But there are a lot of things which the government is doing right. Just that few things needs tweaking in the tax laws. That is where we are raising a voice.
Yes.
Yeah.
बट वो सुकून मिल रहा है, आज बहुत लोगों को चैन की नींद आने वाली है.
So I hope everybody, takes up GST audit and don't consider this as only a form filing exercise. Don't consider this as only a number game or a reconciliation exercise. Do it with a proper spirit of, proper technical validation and verification, and add value to the client. Wish you all, now it's a working time. So I hope, next 40 days, you all take care of yourself and work diligently for closure of this GST 99C. I would love to, come and meet and give a lecture before all of you with a lot of good news coming about the vaccine. We are sure by April 2021, we all should meet without any fear. So thank you all once again.
Yes, thank you. Sir, on behalf of you, we'll be contributing to the CA Benevolent Fund. So that's the practice we follow at Pune camp. So we'll be contributing on behalf of you. Also, Yes, sir. Thank you. And also, all those who have joined late, you can watch this session later on YouTube channel, Pune Camp CP Study Circle, and if it will be available anytime. And the next seminar is on 5th of December. We'll be soon posting the details. Thank you, everyone. Thank you so much.
Thank you. Thank you.